Welcome back to the Deep Dive. Today we are taking a really close look at Global Health Limited.
Right, the company behind the massive hospital brand, Medanta.
And we've got a whole stack of material here. The official Q2 and H1 investor presentation for FY 2026, some recent news, and pretty detailed technical stock analysis.
And it all paints a picture of a company at a very exciting but also extremely expensive turning point.
It really does. It's like we're looking at two completely different stories playing out at the same time.
Exactly. On one hand, you have this immediate financial strength.
And on the other, you have the immediate financial pain you need to fund this explosive future growth.
That's our mission today. To synthesize that tension for you, we need to understand what's bringing in the impressive revenue right now.
And then figure out how that squares with the massive amount of capital they're deploying for the future.
Is that trade-off worth it? And
Yep.
what is the market telling us about the strategy right now?
Okay, let's jump right into the financial health check. Q2 FY 26.
Let's do it.
On the surface, the numbers look fantastic. Consolidated total income grew nearly 15% year over year.
Yeah, hitting INR 11,189 million.
And the bottom line, profit after tax, surged over 21%. That's up to INR 1,584 million.
It sounds like a dream quarter, doesn't it?
It really does.
But here's where we need to add that critical context.
Yeah.
You have to look at EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Right, because that's what reveals the real cost of their ambition. We have to sort of separate the established business from the new project costs.
So if you isolate the numbers, you look at EBITDA, but without the brand new Noida facility.
Then the growth is strong. It's robust, 13.7% year over year.
Okay, so that number, the 13.7%, that's the healthy, established Medanta network.
Precisely. But when you look at the official consolidated figure, the one that includes Noida,
It drops.
it drops drastically, down to just 5.7% growth.
Hold on. So that new Noida facility is acting like a serious anchor on the results. Just how big was that drag?
It was significant. The Noida facility only just started phase 1 operations in September 2025, right at the end of the quarter.
So it barely had time to generate revenue.
Exactly. It brought in a nominal INR 39 million, but, and this is the kicker, it generated an immediate EBITDA loss of INR 197 million.
Wow.
That's the cost of scaling. You have huge upfront costs, staff, training, firing up all that expensive equipment, marketing, all before the patient volume really starts to build.
So the lesson here is pretty clear. They're deliberately sacrificing today's official profit number.
For tomorrow's massive market share.
That puts the other operational metrics in a really fascinating light then. It shows how strong the rest of the network has to be to absorb that kind of loss.
It does.
The core hospitals are still delivering. Inpatient counts are up 12.7%, outpatients up 14.9%.
Then occupancy is holding steady around 64%, even with more beds coming online.
Which brings us to the metric that shows where the real money is coming from.
ARPOB, average revenue per occupied bed. That grew 5.5% to INR 65,570. But what's really interesting is why it's rising.
It's not just inflation.
No, it's not.
It's a strategic shift, right? They're pushing into more complex, more specialized care.
Precisely. They are deliberately optimizing their specialty mix. They're pushing towards these high-value services.
Like cancer care.
Exactly. The revenue contribution from cancer care is rising steadily. It hit 20.7% this quarter, up from about 19.8% the same time last year.
So that focus on complex cases is what lets them command a higher ARPOB.
That's the engine. And you can see this play out when you compare the different hospitals.
The mature hospitals, the ones that are over 6 years old, they showed solid but steady growth, about 5.4%.
But the real energy, the proof of concept for this whole strategy is in their developing hospitals.
The ones less than 6 years old, but not counting Noida.
Right. Their revenue just surged, up 28.3% year over year.
And the EBITDA.
Exploded, up 34%. They're hitting these incredibly profitable margins of 31.5%. They have a working model for this.
Okay, before we move on, I have to ask, if they're spending over INR 41 billion on the future, shouldn't we be worried about their cash reserves?
Yeah.
How is the balance sheet holding up?
That is absolutely the right question to ask, and the answer is it's resilient, which is key.
So they're not bleeding cash.
No, they still have a strong net cash surplus of over INR 7,000 million. Yes, gross debt went up, but that was just the necessary loan drawdown for that huge Noida project. They have the runway.
So that drag from Noida, it's the price of admission.
It is.
And to really understand if that price is worth paying, we need to shift focus to the just the sheer scale of the blueprint they're executing.
It is
We're
staggering.
talking about a total planned capital expenditure of over INR 41,200 million for the next 5 years.
With most of that, about INR 36,700 million earmarked just for project expansion, this is aggressive world-class scaling.
We already know Noida is operational with phase one,
Uh-huh.
226 beds so far?
Out of a planned 550, yeah. And they've already deployed really sophisticated tech there, the Da Vinci robotic system, for instance.
But they're adding beds everywhere. Patna got 57 new beds.
And a whole new 110-bed hospital in Ranchi just became operational in July.
But the future flagships, they are on another level. Let's talk about Mumbai, the Oshiwara project.
Right. This one got a huge upgrade. They received additional FSI approval.
FSI being floor space index.
Exactly. It's the regulatory permission that tells you how much you can build on a piece of land. And that approval let them boost the planned capacity from 500 beds
To a colossal 750 beds.
and the project cost for Mumbai alone jumped to around INR 15,300 million. That is a statement of intent in India's most expensive city.
And they're not stopping there. They're locking down the Delhi National Capital Region.
Two huge projects, a 400-bed hospital in South Delhi with DLF,
And they signed an O&M agreement for another massive facility, right?
a 750-bed hospital in Pitampura. The O&M, the operation and maintenance structure, is interesting.
It's a faster way to scale.
It is. It means they manage the operations, the doctors, the brand, using infrastructure built by someone else. It's efficient. And don't forget their geographical moves.
Into the Northeast, the Guwahati Assam project.
Yes, they held the groundbreaking ceremony in October for a planned 400-bed super specialty hospital,
And the location there is key. It's right on National Highway 27.
which gives patients access from the entire Northeast region. They're building a regional hub.
So if you put it all together, what does that trajectory look like?
It's an explosion. They had 3,435 installed beds in September 2025. The long-term plan targets 6,382 beds by FY27.
That's a 56% addition in beds.
This isn't just growth, it's a complete redefinition of their size in the market.
Okay, so we have this massive, profitable expansion plan. We have the strategy. But then you look at the stock chart, and it's showing significant selling pressure.
Right. Why? Maybe the market isn't fully buying the story, or it's just reacting to that short-term earnings drag we talked about?
To understand that long-term story, I think you have to look past the spreadsheets for a minute. You have to understand the core identity of the company.
That's a great point. The brand identity is really anchored in its founder, Dr. Naresh Trehan, highly regarded, a recipient of high civilian honors.
And that guiding philosophy, Harak John Anmol.
Every life is invaluable.
This high-touch, patient-first approach with state-of-the-art equipment, it's critical. It's what allows them to charge the premium they need to get a return on these huge new facilities.
That philosophy has to justify the cost. Which brings us back to the market. Let's connect this ambition to the technical view.
Despite all this strong business news, the stock has seen a serious correction. What, 20 to 25% off its recent highs?
At least, the price action confirms it. There was an uptrend that peaked around October, and then a pretty clear downtrend took over.
What are the key technical indicators telling us?
The crucial signal is the moving averages. We saw what's called a bearish crossover in late October, early November,
The short-term price average dropped below the long-term average.
which is a classic signal that selling pressure is in control. And you can see it in the volume, too. Recent spikes are dominated by these large red volume bars. Heavy selling.
So the market is skeptical, either about the short-term costs or maybe the execution risk of scaling this fast.
It seems so.
Is there any potential for a turnaround in the near term?
There might be a short-term inflection point coming up. We can look at the RSI, the Relative Strength Index.
Which measures momentum.
Right. It's currently at 35.67. The oversold threshold is anything below 30, so it's getting close.
Meaning the selling might be getting exhausted.
It could be. While the momentum is clearly bearish, it suggests a short-term bounce or at least a consolidation is possible if buyers step in at these lower levels.
Seeing it as an overreaction to the Noida drag.
Perhaps. The technical experts we're looking at suggest that a close above the 1200 mark might be the trigger needed to regain some upward momentum.
Oh, okay. Let's try to synthesize everything then. What's the core takeaway here?
I think the core tension is this. Medanta is a high-growth machine. That's proven by its developing hospitals, that rising ARPOB, the focus on specialized care.
Wow.
But it's making a massive, deliberate sacrifice of today's profitability to fund an explosive multi-billion rupee expansion that's going to completely redefine its market position tomorrow.
And the market, based on the stock chart, is wrestling with the price of that ambition.
That's it in a
All
nutshell.
right, so here's the final thought for you to consider as we wrap up this deep dive. The company is betting INR 41.2 billion on infrastructure.
With these huge flagships in high-cost cities like Mumbai and Delhi.
Exactly. And we noted their strategic shift toward high-value, complex care like cancer and advanced surgery. So, given the economics of building 750-bed facilities in those cities, how critical will maintaining or even increasing that focus on premium, complex specialty services be to ensuring they actually hit those ambitious 31% EBITDA margins in the new hospitals? That blend of philosophy and hard economics, that is the ultimate metric to watch.